Welcome everyone. This is a special edition of Cutting Through the Noise. I'm talking today with Scott Sumner. Scott is the Ralph G. Hawtrey Chair of Monetary Policy at the Mercatus Center of George Mason University. He's also Professor Emeritus at Bentley University and a research fellow at the Independent University. Welcome, Scott.
Thank you for inviting me, David.
Thank you. Now, we're going to cover three things in this video. First is the Federal Reserve mandate, and we'll talk about the previous Great Recession, and then what should the government do now? So tell us, what does the Federal Reserve actually do, and why is it important?
It controls monetary policy, and it's been given a mandate from Congress to produce stable prices and high employment. And so it's usually called a dual mandate. The Fed has interpreted stable prices as 2% inflation measured by the PCE. And high employment is interpreted as an unemployment rate close to what's called the natural rate, which is hard to estimate precisely, but is somewhere around 4% or so.
Great. And in your opinion, which of those comes first in the United States?
Officially, they're supposed to be treated as equally important. I think people tend to focus more on the inflation mandate. And one reason for that is it's the Fed's view that if they keep inflation relatively close to 2% and stable, it will, as a side effect, also produce more stability in the labor markets, sort of killing two birds with one stone. But there may be times when the mandates conflict to some extent, and when they do, they're supposed to be treated as equally important. So there could be occasions where they let inflation rise or fall from 2% to help with the labor market.
And how have they done? What's their track record of hitting their 2% inflation target?
Long term, they've actually been pretty close since, say, around 1990. Inflation's averaged maybe 1.9. In the last decade, they've tended to undershoot the inflation target. Usually numbers around 1.5% instead of 2 would be typical. On the employment mandate, in my view, they were way too passive in trying to push unemployment down during the Great Recession and the aftermath. But they eventually, over a long period, did get it down to a fairly low level, very low level, in fact, about 3.5%. Of course, now it's likely to rise sharply.
Sure. Let's go over the car metaphor briefly, because I think it will be instructive as we go.
Well, if you're talking about the metaphor of driving, you can think of monetary policy as sort of control of the accelerator. And let's say your goal is to keep the speed at 60 miles an hour. To do that, you have to push harder or less hard on the accelerator in order to keep the speed stable when you go up and down hills. So if we use that metaphor, if the goal is, say, 2% inflation, then the Fed will occasionally have to raise and lower interest rates to keep inflation close to its 2% target. And in my view, it's more useful to think in terms of the goals of policy, like are we achieving 2%, not the instrument, like adjusting short-term interest rates, right? So let me give you an example. If inflation is falling below 2%, then that's pretty good evidence that money is too tight, even if the Fed is cutting interest rates. It would imply it's not doing enough to stimulate monetary policy. In other words, you always want to set monetary policy, not so much that you have 2% inflation at the moment. Often you can't control the immediate, but you want to set policy so that markets believe you'll have 2% inflation over the next few years. And if you're not setting it consistent with markets believing you'll achieve your goals, then that's pretty strong evidence that policy is off course.
Right. Now, in 2008, I think most people would agree that there was just too much housing being fed by low interest rates and too much money and lax lending and, let's call it, loose monetary policy. How would you describe it?
I differ a little bit. I think you can make a case that monetary policy was too expansionary during the housing boom. In my view, the housing boom happened for reasons that were sort of mostly unrelated to monetary policy. Housing's only 3 to 6% of GDP, depending on where you are in the cycle. So housing obviously got very strong, but I also think people misjudged the cause of the recession. The collapse of housing only would have caused a minor downturn. In fact, the first 2 years of the housing slump, unemployment increased very little. It's only really when spending across the economy, so-called nominal GDP, total spending, really slowed in late 2008, that unemployment rose sharply. And that was a decline in almost all industries, not just housing. We thought we had a housing crisis that just got worse. And in fact, it had morphed into a broader aggregate demand crisis that caused for a need for monetary stimulus.
So in your view, what happened or didn't happen in the summer and fall of 2008 that should have? And keep in mind that in the summer of 2008, commodity prices really rose, right? There was a jump in commodity prices.
Right. Commodity prices rose, headline inflation rose, but if you looked at underlying variables like nominal GDP growth, total spending, those were slowing. And I've argued that nominal GDP growth is a better measure of monetary conditions. And it turned out in that case it was. That signal was correct. The inflation bubble quickly burst and we went into deflation in early 2009. And what the Fed should have done is create a level target for either prices or nominal GDP. That's where, imagine drawing on a graph paper a price level rising 2% a year, let's say. With level targeting, whenever you fall short or overshoot, you promise to come back to that trend line. And that creates more bullish expectations in a recession because investors know that even though we're temporarily below that trend line, the Fed will do whatever it takes to push us back there over time. That creates higher expectations for growth in spending and prices, and it supports more velocity of money in circulation, and eventually it will help the Fed achieve its objectives. The Fed has to still do concrete steps, but the most important thing the Fed can do is have the right target, and that requires level targeting. Traditionally, the Fed relies on interest rate cuts. They should have cut rates much more sharply and rapidly. I'll give you an example. After Lehman Brothers failed in September, the Fed had a meeting and voted not to cut interest rates. Now, in many people's minds, they have this image that, oh, the Fed did everything it could in late 2008 and it just ran out of ammunition. That's not at all what happened. Rates didn't even fall to zero until the end of the year, by which time most of the slump was actually over. Second, even when rates fall to zero, the Fed can be much more aggressive with buying assets and injecting money into the economy. Now, eventually they did do some QE programs, but they were far too small. They should have bought a much larger amount of assets. So those two mistakes, not cutting interest rates fast enough and doing far too little QE, were the sort of tactical mistakes, the mistakes in terms of their actual tools. And then there was this broader strategic mistake of not promising to come back to the trend line when conditions improve. Instead, we stayed permanently on sort of a lower track for both prices and nominal GDP.
Right. One thing people will help people to see, if you look at Fred and you see over many recessions, you see that we generally have a recession, but then we come back to the trend line.
Right.
And then something bad happens, but we do manage to come back. But in 2008, 2009, it went down, and then there was a new trend line from there. It didn't.
That's exactly right.
Right. So to use the car analogy, if they had pushed the pedal down hard in September, they wouldn't have slowed down so much that they had to throw, and they didn't even throw enough at it later. So the whole thing was very anemic.
Right. And I think there's even within the Fed recognition that they made some mistakes then. If you look at Ben Bernanke's memoir, he said the Fed made a mistake of not being more aggressive after Lehman failed.
Great. Now, what happened in Europe?
Europe did an even poorer job than the United States. And that's partly because the ECB was set up much later, and it was set up in a climate where people believed that the main problem would be holding inflation down. This institutional setup, plus the need to get agreement among many countries, created a strong bias towards more deflationary policies. As a result, and this is actually very revealing because, at the beginning of the Great Recession, the Europeans were looking at America and thinking that we'd sort of blown it. We'd had this wild cowboy capitalism, unregulated, and now we were paying the price with a housing bubble that burst and banking crisis. So there was initially a perception that the recession would be worse here because that's where most of the subprime problems were. But as you may know, the recession was much deeper and longer in Europe than the United States, and that's because monetary policy was even more contractionary in Europe. So all the way from 2008 to 2013, rates were well above zero, and the tight money policy in Europe could not be waved away by reference to zero interest rates or an inability to do more. It was an active ECB policy. Do you know they raised interest rates in the middle of 2008, and they raised rates twice in 2011? Both times, the economy immediately tanked in Europe right after both interest rate increases. These were affirmative actions.
Putting on the brake.
Right.
Actively putting on the brake when you get to a hill.
And let me give you another important brake metaphor. There was a lot of talk about why aren't we achieving the inflation target in 2016, 17, 18, right? Mm-hmm. And there were so many pundits wringing their hands and saying, well, the Fed seems unable to achieve its inflation target. Well, during those years, the Fed raised interest rates 9 times. Every one of those 9 interest rate increases were explicitly to hold inflation down, because their models suggested the low unemployment would soon lead to high inflation. So the driving metaphor I like is someone brings their car back to the dealer and says, you know, I have trouble getting this car up to 60 miles an hour. I keep tapping the brake and it just won't go up to 60 miles an hour. And it's sort of amazing that people didn't connect the 9 interest rate increases of the Fed with their failure to achieve 2% inflation, and instead said they must be unable to do this.
And perspective is so important because, as you explained, you can have low interest rates and still have tight monetary policy.
Exactly.
You can even drop interest rates and still have too tight.
Right. That's a subtle point that a lot of people miss. So there's something called the equilibrium interest rate, which is sort of the rate that if you set rates there, you should get your policy goals achieved, like 2% inflation. And that's kind of unobservable, but you can estimate it. Now, in a slump like 2008 or the current environment we're in, the equilibrium interest rate falls fast. The Fed usually cuts rates, but more gradually. So what's actually happening is even as rates are being cut, policy is effectively getting tighter because the equilibrium rate is falling even faster.
Right. So doing nothing is an act of monetary tightening.
There's really no doing nothing. Just as someone driving a bus can't really be doing nothing, they're always setting the steering wheel at some position, right, which will determine the path of the bus.
Right. So we're going to have to save paying interest on reserves for another time because we've got to get through this. But the Australians at the time, still with the Great Recession, gave $800 Australian to every adult, I think, and injected, let's call that fiscal, helicopter drop from the fiscal budget, government budget, and the Australians didn't really have experienced much of a recession or any recession technically, right?
Right.
Can you explain?
They haven't had a recession since 1991, although I presume that'll change with the global situation today. But right, and they've done a pretty good job with monetary policy. And interestingly, because they've done a good job and avoided recessions, they haven't really had to take extreme measures like negative interest rates or QE, because when an economy is growing at a healthy rate, the equilibrium interest rate will stay above 0, and you can kind of do just normal, boring, ordinary monetary policy. So it looks like you're actually having a less expansionary policy than those taking desperate measures, but it's because in the past you've had a more expansionary policy and never got into the crisis in the first place. You've kept your nominal GDP growing at a robust rate, and Australia traditionally had a little bit faster growth in nominal GDP than the US or Europe and did avoid the Great Recession.
And did their strong balance sheet help with that? They weren't running a big deficit and they weren't piling up that much debt as the United States had, or?
Well, a little bit perhaps. It certainly gave them room to do fiscal stimulus when needed. My own view is fiscal stimulus is overrated. Obviously, a lot of economists disagree with me, but I would say if you do believe in fiscal stimulus, then what we've been doing in recent years is very unwise, because the huge increase in the budget deficit has meant that we have less room for fiscal stimulus than if we'd had a normal, a low deficit during the boom so that you can raise it sharply during the recession. It's the change in the deficit that really provides the stimulus.
Do we have any evidence that the Australian helicopter drop did anything for the economy?
If you do that alone, fiscal alone, there's no monetary creation, right? So you're
Yep.
borrowing money,
Yeah.
you're taking money, you're borrowing it from one person and giving it to another. You don't create new money. So that's fiscal.
Right.
And then when you do monetary policy, you usually print new money and then buy bonds with it. Well, the two can be combined by doing fiscal spending and getting the money instead of from borrowing, getting it from newly created money. And now you've combined monetary and fiscal, and that's the helicopter metaphor.
I see. That's generally what is meant by the helicopter.
Right, combining the two.
Right. I want to come back to fiscal stimulus in a minute, but let's talk about now. Let's look at the big picture right now, and you're looking at the whole United States government. You get to press the levers. What do you think the U.S. government should do right now? And by the way, this is middle of March, right? March 18th, and we're after about 10 days of pretty seriously realizing that there is going to be some considerable disruption to the economy.
Right. So I don't think there's anything that can be done to alleviate the immediate impact on the economy from the virus. This is a very unusual shock. It's a shock where people are fearful to spend. Normally we have shocks where if you provide people with money, they will go out and spend, at least to some extent. The problem isn't fear of spending money and shopping and traveling and so on. So this kind of a unique type of shock is something that will, I think, depress the real economy for some period of time. And I don't know as much as you do about the epidemic itself. But let's put that aside and ask what monetary policy could do at this moment, or fiscal policy. So in my view, the focus should not be so much on the immediate economy, but providing a monetary framework where people expect more growth in 2021, 2022, the out years. What worries me right now is that we may do what we did in 2008, which is allow a sort of acute, sharp shock to the economy to linger for many years with a slow recovery. There's no reason why we couldn't have and shouldn't have a fast recovery once we have, say, a vaccine or something that reduces the problem of the epidemic. The financial markets don't seem to be expecting any kind of robust economy for many, many years. They're very bearish, not just about this year, but the out years.
Yeah.
And this makes me think that we need a more expansionary monetary policy, and especially a more expansionary framework like level targeting, which would provide assurance that if we have a deep drop this year, that the Fed is committed to get a V-shaped recovery when possible, as much growth, as rapidly returning to full employment as possible. And level targeting of either prices or nominal GDP can help do that. And then also, I think the Fed should ask Congress for permission to buy a much wider range of assets in an emergency. Now, here my thinking is I would actually prefer they not buy a wider range of assets, but they have the ability so that markets are convinced they will do ultimately whatever it takes.
Mm-hmm.
Currently, the Fed can buy treasury bonds and mortgage-backed securities, and there's like, I think, 30 trillion or more of those outstanding. So I believe there's actually plenty of conventional ammunition that the Fed can employ. But having the ability to buy a wider range of assets in an emergency will convince markets that the Fed will ultimately do whatever it takes to hit their 2% inflation target, even if they have to buy a vast amount of assets and really flood the economy with money. I'd like to emphasize that central banks, in a technical sense, never run out of ammunition.
Mm-hmm.
Any problems are political.
Mm-hmm.
If you print enough money, you can create hyperinflation, as we saw in Zimbabwe.
Right.
The only limit to what monetary policy can do in terms of nominal or money spending is political. That is, there may be rules that say the Fed shouldn't go beyond this line in terms of what it can purchase.
Right.
But importantly, even in the Great Recession, the Fed never came close to even exhausting its conventional ammunition. The QE programs were very small relative to what it could have done legally at the time. So first it should exhaust those conventional tools, and then Congress should give it the ability in an emergency to buy a wider range of assets. And I would prefer that be done in a neutral way, say buying index funds of stocks and bonds, not picking companies or favoring this company over that company.
Right. Industry.
And
right.
then when the emergency is over, those private sector assets should be sold, and they should go back to a balance sheet of just treasuries, because I don't want the central bank to be permanently propping up private asset markets.
We
So
have that
if it's needed, it should only be in an emergency. Pardon?
we have that in Japan and Switzerland, don't we? Those central banks own quite a bit of private company stock, don't they?
Right, and there, it's been kind of a defensive move on their part. They're reactive, not proactive. So they've slid much deeper into the sort of a zero or negative interest rate environment where everyone wants to hoard cash. So there's an enormous demand in those two countries for people and institutions to hold cash and bank reserves. They've been meeting that demand by issuing money and buying assets, including stock, with that. Fundamentally, though, they need a different target. They basically need a policy that creates enough inflation so that people want to just hoard zero interest cash, basically.
So if I understand,
and as long as they don't do that, they're going to be reacting defensively by adding liquidity to meet panicky demand, not really generating a robust recovery.
so if I understand your priorities, you would say to all central banks, or at least the big ones, forget about interest rates and forget about unemployment. Focus only on nominal GDP.
Right. But nominal GDP does implicitly address the labor market. So it's the sum of inflation and real growth. So if you have stable growth in nominal GDP, you tend to have a more stable labor market, and you avoid these periods of high unemployment like we saw after the Great Recession. So although I don't favor targeting inflation or unemployment, I believe that stable growth in nominal GDP would produce better outcomes for those two variables.
Right. It's kind of like, instead of driving down the road, steering the wheels independently, which probably they're gonna fight each other most of the time, right? You just steer with one.
Right. It's sort of balancing these two goals embedded in the dual mandate. And there's trade-offs. So you're going to have periods where one is a little above target, one a little bit below target, and vice versa.
Right. Now, the Fed knows about nominal GDP level targeting. If I remember correctly, your license plate says NGDPLT.
That's right.
The Fed knows. The Fed was asking questions last August in Chicago, was it?
So here's my take on this. In the last decade, a number of prominent academic economists have sort of come around to advocating NGDP targeting. They've seen the advantages. They've seen clearly it would have done better than inflation targeting in 2008. But central banks are kind of like conservative institutions that are reluctant to change. And that's understandable. They have to have credibility and trust in the public. They believe that the messaging in their 2% inflation target is very important, and they're reluctant to just sort of like walk away from that and say, oops, we promised this inflation rate, but now we're going to go to NGDP, which they say the public doesn't understand as well.
True.
But I think actually they've got that backwards. The public doesn't really understand inflation targeting.
Inflation, right.
See, the public thinks that the Fed is trying to hold down inflation below 2%.
Right, they think inflation is evil. Right?
But when Ben Bernanke announced in around 2010 that inflation was only about 1%, he was going to try to raise inflation to 2%. There was all this criticism, like on talk radio, why is the Fed trying to raise your cost of living when we're in recession?
Right.
The public doesn't understand that it's a symmetrical target where the Fed views low inflation as just as bad as high inflation. Now, what if the Fed had said in 2010, we've noticed that the economy is more healthy when Americans' incomes are growing at least 4 or 5% a year. So we're going to try to get income growth up to 4 or 5% a year to restore jobs and make our economy more healthy. I think that would have clicked more with people. There would have been more of an intuitive understanding of what the Fed is trying to do.
Right. So putting it in terms of their take-home pay at the end.
Right.
Is probably a better way, and that is nominal. You get paid in nominal dollars, right?
They could, instead of calling it nominal GDP targeting, they could call it national income targeting or something like that. That would click more with the public, I believe.
All right, let's go to the federal side of that, or to the fiscal side of the house. Now, Hong Kong just gave 1,200 Hong Kong dollars to each person. I actually have no idea if that buys you a cup of coffee or not. I don't know how much that's worth. But many governments, and Mitt Romney is proposing, and people are talking about dropping money on the American. What should the fiscal side do?
Personally, I'm not a fan of fiscal stimulus. I think monetary policy is both more effective and less costly.
Could
Let me
be
explain the cost.
a short-term benefit to some kind of fiscal activity, right? Right now.
It's possible there is, but it kind of depends on the interaction between fiscal and monetary. So if fiscal does more, how does the Fed react? Does the Fed do less because it knows fiscal is doing more? That's the hard thing to game plan. So I can't actually precisely answer that question. But what I can say is that historically, the results of fiscal have been very disappointing. They haven't met the predictions. Like there was a fiscal stimulus in 2009. The results weren't what was predicted. There was an austerity, interestingly, in 2013. Many Keynesians predicted a slowdown in the economy. It did not occur with a reduction in budget deficits in 2013. The results just haven't been very impressive. It's not that it can't work at all. It's that it needs to be taken into account what monetary policy will do. And since monetary policy is much more powerful, I prefer the focus there. In addition, fiscal policy is costly because it raises the debt and the future tax liabilities. Monetary policy is not really costly. It doesn't raise our national debt. It does not increase our future tax liabilities. It's more analogous to steering. You set the steering wheel at a different position that's more optimal. Whereas fiscal is like gas, you press down on the gas pedal and you use gasoline, right? So it's costly in that sense. But setting the steering wheel at one position or another is not more costly, right? And I think of monetary policy, I'm sorry for mixing the metaphors, by the way.
There's a difference between
But I think monetary policy is more like steering. You set it at a different position.
Yeah.
One monetary policy setting isn't really more costly than another.
Uh-huh.
So I would prefer the focus be on monetary. Now, if fiscal wants to do something useful, it seems to me that it's more along humanitarian lines. People will be losing jobs.
Yeah.
You could extend unemployment compensation beyond 26 weeks if the virus lasts longer than that, which it obviously may.
Yeah.
You know, do some of these things that provide targeted relief instead of just giving everyone, including me, $1,000. I don't personally need $1,000 from the government. I'm employed.
Right.
But so in my view, if there are fiscal actions, I would like to see them more targeted, and the heavy lifting for getting inflation back up to 2% really should be with monetary stimulus. It has much more powerful tools to work with.
Nominal GDP is GDP plus inflation, so we're talking about a 5% range.
Yeah, people have proposed either a 4 or 5% target with the idea that you'd have 2% inflation and 2 or 3% real growth.
Right.
To me, the exact number there doesn't matter. It's the stability. Either one would be fine if it was stable over time. You don't want fluctuations, basically. Let me just say there's really two reasons why nominal GDP stability is important, growth stability. It's the funds out of which we pay wages and salaries, and it's the money people use to repay debts, people and businesses both. So let's take wages and salaries. When nominal GDP falls sharply, there's less revenue flowing into businesses to pay wages and salaries, and unemployment goes up. They lay off workers. Also, when nominal GDP falls sharply, there's less income being earned by people and businesses to repay their debts, which are nominal debts. They're not indexed to inflation. And because there's less income being earned, debt defaults increase. So you tend to get debt crises in periods like the 1930s or 2008 or other periods where nominal GDP falls. Then people are stressed. And that's why you want to have stable growth in nominal GDP. You get a more stable labor market and a more stable financial system. Unfortunately, the epidemic is a little bit like that asteroid strike. It's a real shock. It's something we have to work through. And that's, again, why I focus on monetary policy being aimed more at expectations for next year, the year after. We need to really work on getting spending recovering in those out years, as there's probably almost nothing that can be done for the next few months. It's going to be a very weak economy, I believe, for that period of time.
Yeah, so technically we could have a couple quarters of negative growth.
Yes. Now, even then, I suppose you could argue for maintaining nominal GDP growth with this argument. You get a lot of inflation and falling real GDP, but because you'd have nominal GDP growing, it would still be easier for people and businesses to service their debts. So in other words, businesses in that environment would see a fall in real quantity produced, but they'd sell it at higher prices, so they'd still earn revenue to repay debts. But it'd also be a very uneven situation. Some businesses would be doing more than fine. Others would still, like the cruise ships, obviously, they're not going to get a price increase that offsets their fall in output in the near future. So what we have is a real shock that also impacts various sectors in an uneven way. I think the economist Arnold Kling called this a reallocation problem. We have to reallocate resources, labor, and others from declining industries to growing industries. That takes time. And so this is a more difficult cyclical problem than the typical just lack of spending, inject money, and everything is solved. It's a more profound problem.
It occurs to me that in the new normal, commercial real estate for the next couple of years is probably going to suffer.
Yeah, and one of the questions is how much of that will be due to this real shock of people working from home and so on. But I worry that over time, the economy may remain depressed even as we address the epidemic. It's really too soon to say, but that's something we need to watch because that's exactly what happened after we addressed the banking crisis. And once that banking crisis was addressed, the economy remained depressed for a number of years, and I think needlessly.
If the Fed could adopt nominal GDP level targeting and just push the gas now and buy assets, get money into the economy, would there be a scenario in which the economy doesn't make that recovery back up and still continues because a lot of dominoes have yet to fall? Or is it the absolute commitment to whatever it takes that will bring it back up to catch up?
Well, let's break that into two parts, nominal and real. There's no doubt in my mind that a sufficiently expansionary monetary policy could create nominal GDP growth over the medium term, say next year, the year after, and so on.
Okay.
Whether that nominal GDP growth is associated with real GDP doing well depends on how strong the headwinds are from the epidemic.
Right.
So in a worst case scenario where we shut down much of the economy to create social distancing, success on the nominal front of creating nominal spending would show up as like what's called a supply shock, high inflation and low real output. So that's a possible scenario. And again, I don't know how long this would last, but there is, I think, a plausible dividing line where if there was something like a vaccine which really dramatically changed our social distancing situation, then at that point, the problem would become purely a nominal problem of just, let's make sure we have enough money to get full employment. There'd be no physical barriers, if you will, to creating a healthy economy. Until then, this is such a unique shock that I don't have a good sense of how quickly our economy can kind of reallocate spending from, say, going out to eat to home delivery of groceries. So we're going to lose jobs in restaurants and create jobs in, men and women driving groceries to people afraid to go out of their house. Right. But it's not going to be a smooth transition. And we know that the longer out you go, the better able an economy is to readjust, re-engineer to a new environment. But this is such a unusual environment that I'm hesitant to predict, the timing of how that will play out.
Of course. Yeah, there could be a serious wave coming in the fall, as we saw in 1919.
Exactly.
And that could be even bigger than the way we see now, or not. We don't know. There's too many unknown variables there.
But, I believe that even if they just committed to a level targeting regime at 2% a year, where they said, look, we want the prices to be 10% higher 5 years out in the future, and we'll do whatever it takes to get there. Even that would have a side effect of implicitly promoting higher nominal GDP expectations, because right now it looks like inflation will undershoot considerably for a number of years.
In fact, Powell said so a few days ago.
He did that inflation? Okay.
He said we're definitely, and he uses careful language, we're going to be,
right.
We're going to not be hitting our price targets. And so he never uses the word inflation. Right?
Certainly this year, we will fall short. And that's what makes this so unusual. Normally during an adverse supply shock, like an oil embargo, you have high inflation. But this is like a real shock that hit spending. People are afraid to buy. It's not our productive capacity has fallen. It's our unwillingness to spend. So it's like a real shock to demand rather than a real shock to supply. And that's what eventually we have to adapt to and either re-engineer our economy or, again, hopefully there's a virus at some point and we can go back to the old way of doing things.
Yeah, a vaccine.
a vaccine, did I say virus? Sorry.
There will be a vaccine, that's clear.
Right.
But there will be fears of another virus and things will be different. There will be a new normal. Well, I want to talk to you more about that in a future episode. People mention MMT, modern monetary theory. Can you just quickly say what that is and whether that's any part of the solution now or not?
Well, it's kind of hard to define. It's a little bit like the opposite of my market monetarist view of things. So I very much emphasize monetary policy.
Right.
And MMT de-emphasizes monetary policy and really focuses on the fiscal side. Right. So it's relatively pessimistic about what central banks can do, whereas I'm pessimistic about what fiscal policy can do. There are a number of technical differences. Every time I've tried to explain them in a blog post, they've told me I got it wrong. But then Paul Krugman runs into the same problem, so I feel a little bit reassured by that. But yeah, they're known for promoting the idea that, don't worry about spending a lot. It's don't worry about big budget deficits. Mm-hmm. If there is an inflation problem, you just raise taxes. You don't address it with tight money. So it's a very sort of fiscal-oriented view of things.
One critical difference between monetary theorists or monetarists and Keynesian is that monetarists don't believe that the government should be in the interest rate business at all. Is that fair to say?
Right. So traditional monetarists favored targeting, say, the M1 or M2 money supply, which includes bank deposits. Myself and some of the other market monetarists favor targeting nominal GDP. We worry about changes in velocity. But we view interest rates as a misleading indicator, and we worry that they're often behind the curve when they're targeting interest rates too slow to change interest rates. In my sort of dream policy, there'd be a creation of a highly liquid nominal GDP futures market, and they'd set monetary policy at a rate such that the market believed nominal GDP was going to grow at 4 or 5% a year. Right. That's not going to happen in the near future. Until then, I believe they should set policy where basically they would look at a wide range of market indicators and try to estimate what the markets think is likely to happen going forward from all these market indicators, and just do the best they can in terms of creating a policy stance that's appropriate. But I would move away from focus on interest rates to a focus on more the supply and demand for money, especially the supply through like QE programs where you can inject more money into the economy.
Right. So it sounds like you're more in favor of looking out the front windshield than in the rearview mirror.
So I believe that that's a good metaphor for using the markets. Like if you look at right after Lehman failed, when they refused to cut interest rates, they cited the recent high inflation numbers from earlier 2008 when oil prices were very high. But they were looking in the rearview mirror. That very day of that meeting, the so-called tip spreads, the inflation forecasts in the bond market, were showing sharply lower inflation expectations. Yeah. And interestingly, those tip spreads turned out to be fairly accurate. Inflation did fall sharply in the next 5-10 years.
Some people are worried, though, about the Fed printing money and buying up assets. And they're worried that they'll have a $10 trillion balance sheet. And it's easy to scare people by saying the Fed is this giant monster that is amassing assets, and they have lots of words for for monetizing the debt, you know? And so help us understand, like, what would you say to those people?
You know, monetary economics is sort of like Alice through the looking glass world where everything is upside down from what it seems. The countries with the most contractionary policies, like the US and the Great Depression, more recently Japan and Switzerland,
Yeah,
they end up with very low inflation, interest rates near zero or even negative,
yeah.
and everybody wanting to hold what's called base money, cash and bank reserves.
Mhm.
This is the ultimate form of liquidity. So
Mhm.
people want to hold a lot of that kind of money. As a defensive mechanism, then these countries will inject money into the economy. It will look like they have a highly expansionary policy, but it's actually they're reacting to previous increases in demand for their money because inflation and interest rates were so low.
Mhm.
Now, conversely, countries that were in the Great Recession able to maintain nominal GDP growth at a higher rate, like Australia, there was very little hoarding of Australian money. They didn't have to do QE. So it looked to average people like Australian monetary policy was more contractionary. Interest rates were positive, there was no QE. But in fact, they were not having to take these extreme defensive measures from previous contractionary mistakes that allowed inflation to go too low and brought interest rates to zero. So that kind of Alice through the looking glass world where nothing is what it seems is something you have to really internalize before you can understand monetary policy. When we had 20% interest rates in the late 70s and early 80s, we had very high inflation. That was actually an expansionary monetary policy. Latin American countries with hyperinflation have very high interest rates. But it's just so hard for people to process the idea that high interest rates might actually be easy money
Mhm.
and zero interest rates might be tight money because it goes against all of their instincts.
Right. Now another argument people would say was, oh, now we're almost at negative interest rates. Not only is the Fed out of firepower, but now we're going to have to pay money to have someone hang on to it for us. That sounds really scary.
Again, negative rates are a defensive measure. So are they a good thing? Well, there's two ways of looking at it. It might be better to cut them to negative rates than not do so. But the fact that you've had to cut them is a negative sign on your overall policy strategy, right? So, and it's the same really with QE. The fact that you're doing QE might itself help the economy in an immediate sense, but it's also a sign you've been too contractionary so that you've had to do QE. You have to ask yourself, why do people want to hold so much base money? Why do we have to have negative rates to discourage them from holding bank reserves, let's say? That's the deeper question. That gets to the strategic issue of what's your target? What's your inflation target? What's your nominal GDP target? Do you have a level target promise to come back to that trend line if you fall short?
Mhm.
No country in the world, as far as I know, is doing level targeting. But I think just that switch would help create more bullish expectations as long as it was accompanied by a promise to do whatever it takes to get back to the trend line. There's a reason why they adopt negative rates, and that's because there are political barriers of one sort or another to providing enough money to meet the demand. So an alternative for Europe or Japan would have been to just flood their economies with money. The ECB was set up to avoid that because they worried about inflation, right? So there's all these sort of provisions in the ECB rules that discourage monetary policies that would be highly inflationary. They probably could do more, but it's very difficult given the environment there. Japan has done quite a bit of money printing, but they're so deep into this liquidity trap. The Japanese are still preferring, they've had literally decades of basically zero inflation and lost a lot of credibility during that period.
Right.
And as a result, they really sort of need a shock, a real dramatic regime change. Now, in fairness with Japan, there was a modest regime change in 2013 when the Abe government took power.
Okay.
They actually have done somewhat better since 2013 on a number of indicators, and they did switch from basically a 0 to a 2% inflation target.
Hmm.
they've fallen short, but it did get them out of deflation to very low inflation rates. So I don't mean to suggest that it's had no effect in Japan, but they need something even more dramatic to hit their 2% inflation.
They haven't hit it. They haven't hit it. So,
No.
so
But they did get out of deflation at least, and they got unemployment to a low level. So I don't mean to suggest that Japan is a disaster by any means. It's gotten better since 2013.
But they really need to print more money, isn't that?
Yes. But more fundamentally, a switch to level targeting accompanying that. Right. The irony here is if you actually have a credible commitment to do something, you don't have to do as much. Let me give your listeners an example that might kind of resonate, because this is all very theoretical.
Okay.
Suppose the Japanese brought in the central bankers from Zimbabwe to run their central bank and said, okay, here's what we're going to do. We're going to go back to the old high inflation days of 10% inflation a year. Yeah. And we're going to print as many yen as necessary to do that. And we're going to buy as many assets from all over the world. And if we have to buy all of the stocks and bonds everywhere in the world to get this inflation, we will do so. So we're going to go everywhere in the world, print yen currency, and start buying assets. Now, does anyone actually believe that the rest of the world is going to sell Japan all of its wealth, its real wealth, for yen currency notes that they know are going to be soon depreciating at 10% a year? No. The equilibrium, if you did something that crazy, it's obvious that the equilibrium would be the minute they started down that road, the yen would plunge in the foreign exchange markets rapidly, and they would get their inflation very, very rapidly. Now, I'm not recommending the Japanese do that, but that thought experiment sort of drives home the point that if you have a credible policy to inflate, just that expectation means you don't actually have to print that much money. You will so frighten the markets that your currency will fall in value and you'll get the inflation more rapidly. That's called the expectations channel. Some people derisively call it the expectations fairy because they don't believe it really exists. But it does exist. It's just that central banks are so conservative, they rarely pursue the sort of bold changes that would be necessary to shake up expectations.
Let me wrap up, and I'll just switch my view here so we can sort of say, make it more conversational to wrap up. And that is, you look on YouTube and I'm on social media all the time, and I hear people saying that the Fed is a conspiracy. The Fed is a sham. The Fed needs to go away. They're corrupt. Look, the first thing you should know about the Fed is that they collude with large hedge funds to create moral hazards so that they can reap the benefits of volatility. You hear all these things about the Fed. They never agree to be audited. No one knows who owns them. They're a private bank. Their profits go to the member banks. I don't want you to get all of it, but I want you to just give a reasonable view of what the Fed actually is so that we can kind of debunk some of those conspiracy theories.
Right. So I don't have that negative a view of the Fed, but I won't say there's like zero truth in those assertions. The Fed is an odd institution. The Board of Governors,
they work to make a few hedge funds really rich.
Right. So I'll make 2 points that slightly support that conspiratorial critique. One is that the Board of Governors in DC is a government institution, but the other 12 regional banks are formally private institutions. And that's kind of an odd system because the presidents of those regional banks do have a vote. Some of them have a vote on the FOMC. It rotates. So they're making government policy. You actually are having sort of private individuals making government policy. Now, I don't believe they're doing so to try to enrich bankers in any conscious sense, but you could certainly make a good argument that if they're making policy decisions about our money, this should be made by government employees, right? So that's the whole private question, I think has some validity. It's an odd situation to have almost half of the policy making being done by these private regional banks. I do think Fed policymakers are generally well-intentioned, but I also think that accidentally because of their way of looking at the world, they often put too much emphasis on sort of like saving the banking system and not the broader economy. So in late 2008, they injected a lot of money into the banking system, and they didn't want that to have an expansionary effect because they were still worried about inflation. Remember, I mentioned after Lehman failed, they didn't cut rates. So to prevent interest rates from falling and expanding the broader economy, they instituted interest on bank reserves. They paid banks to just sort of sit on the money. So they wanted the money to help with bank liquidity, but not boost aggregate demand, right? Now, I think they honestly thought that was the key problem. They thought the problem was a banking crisis, not an aggregate demand crisis. But in my view, even at the time, I saw an aggregate demand crisis because I was looking at these forward-looking indicators. And so they were trying to rescue Wall Street without rescuing Main Street.
Okay, we're back, and it's a little different because we had to wait for the next day to finish up our conversation. I'm a little confused hearing you and David Beckworth say that QE is bad, because I thought that QE was just essentially asset purchases. So what's the difference between asset purchases and QE?
No, QE is asset purchases. I favor QE. But by itself, it's not very effective unless combined with other actions.
Like what?
Level targeting. So
just not all by itself.
Right.
Right. I see. So in your language, you wouldn't call it QE because that kind of stands on its own. You would say how would you put it?
Oh, I don't object to calling it QE, but asset purchases, it's just monetary policy. Right. Really, for 100 years, monetary policy has been printing money and buying assets. Nothing new.
Okay.
It was called QE because the quantities were much larger than before the Great Recession, and also because it was no longer being used to affect interest rates, but rather just to inject more money into the economy for its own sake. Fiscal policy is borrowing money and injecting it into the economy. Monetary policy is creating new money. One difference is with fiscal policy, you create debt obligations, which means future taxpayers have to pay at least interest on this debt. With monetary policy, you're not creating future tax obligations. You're creating new money and injecting it into the economy. For that reason, it's not very likely that fiscal policy would be able to come up with anywhere near the amount of money necessary to make a decisive difference in this kind of situation. Even if they injected $1 trillion of money through fiscal stimulus, that wouldn't do too much to the economy. The Fed could inject 10 trillion without increasing our national debt. So it's just the scale of what can be done with monetary policy is much, much larger than with fiscal stimulus.
Right. Now, with fiscal stimulus, couldn't you just get it out of a different budget? Couldn't you say, well, we're going to spend less on fighter planes and not borrow?
Well, that wouldn't really be stimulus anymore. You could do that, and it might be wise to do that, but that would be sort of reorienting spending. It wouldn't really be injecting more money through the fiscal system. Doing it differently.
I see. That makes sense. Okay. And the key that monetarists want people to understand is what's important is to print money and get it into circulation.
Right. And by the way, since I don't favor fiscal stimulus, I guess I would prefer if fiscal policy did something, it would be directing additional or existing money to a more effective place right now. Maybe helping the unemployed, those sorts of targeted programs that would be more useful right now than some other types of spending.
So that brings us to my last question. What about bailouts?
Certainly industry bailouts are inevitable. I understand that. But if I had my way, I would prefer to do things differently. Instead of bailing out specific industries, picking and choosing winners and losers, I'd prefer to use monetary policy to inject an enormous amount of money in the economy, enough so that nominal GDP kept growing. This would mean Americans would still earn higher incomes next year than this year. That should be the goal. And if American individuals and businesses are earning more income next year than this year, it makes it much easier to repay debt. In other words, I'm proposing sort of a macro approach to the debt crisis. I think we could do much more with sort of bailing out nominal GDP, if you will, rather than bailing out individual firms. It's just that macro tools are much more powerful than little case-by-case microeconomic tools in this kind of crisis.
Right, okay. Okay, I'll go side by side to summarize. Now, let's just quickly go over what are the practical steps you believe the government of the United States should take now.
I don't think fiscal stimulus is useful now. As I said, there could be some targeted programs for people that are suffering from this crisis, like helping the unemployed and other related type programs.
Yeah.
Obviously, there could be some fiscal programs aimed specifically at addressing the epidemic, medical area and so on. Again, I'm not an expert on what those programs would be, but you could certainly envision some targeted fiscal actions, but not just doing it to throw money at the problem, basically.
Sure. To help people or industries, is tax relief better than giving money in, or do you have a preference?
Well, the problem here is the people that are going to be suffering the most will be those not paying taxes. They'll be the unemployed. So take someone like myself who will continue to be employed, presumably during the next year. I don't need payroll tax relief because my cost of living is actually going down. I'm doing less trips, less eating out. I pay less for gasoline. I won't be spending very much this year. So I don't really need a payroll tax cut. Those that lose their jobs, I would think, would be those that would need it more. Now, it is true that, from a long-term growth perspective, tax cuts may be more effective in stimulating growth. But if we're just trying to sort of like help people in a crisis, I don't think that should be the number one goal at this moment. My suggestion is going to focus mostly on monetary policy. I think in terms of 3 steps. One would be to set a level target, a path you'd like for either the price level or nominal GDP. I'd prefer nominal GDP, but even a price level target would be very useful, and it's probably more politically acceptable right now.
Okay.
Once you've set that path, you're already 80% of the way there. The next step is to promise to do whatever it takes to hit the path in the future. And that means a willingness to buy as many assets as necessary, to inject as much money in the economy as necessary, no matter how much money is required. And the third step is to use market signals as a guide to whether you are in fact injecting enough money in the economy. So you want to look at market signals and try to estimate whether next year and the year after we're going to get nominal GDP growing sufficiently for a healthy economy. As I said earlier, there's nothing that monetary policy can do right now to prevent a real shock from causing a lot of unemployment. That's just the nature of the epidemic we're facing, and social distancing. What it can do is create expectations of higher incomes in future years, which will tend to reassure the financial markets and prevent a real shock from transitioning into a nominal or demand shock, creating a long-term depression. That's what we should be trying to avoid.
If we have a level target for prices or nominal GDP, and then we throw whatever it takes, do whatever it takes, we buy, we print as much money as it takes to accomplish that. And we do accomplish that. And some years later down the road, we have a recovery and things are looking better. Now, does it naturally unwind those trades and we go back to essentially where we are now balance sheet wise, or are we forever with a larger balance sheet?
No, it should unwind. Again, the market should provide signals. There will come a time where we won't need this excess liquidity, and we can unwind most of those asset purchases. I certainly prefer a target path high enough to have positive interest rates in the long run. In the short run, we're going to be stuck at 0 interest rates.
Right.
But we should have a nominal GDP growth path that's high enough so that interest rates are normally above 0. Now, what that number is, I'm not certain. 4% a year 5% has been discussed, but there is some number where nominal GDP is growing fast enough where interest rates will be above 0. And if that is the case, the Fed's balance sheet can go back to, quote, normal as it was before the Great Recession. It was about 6% of GDP at that time.
Mm-hmm.
The big balance sheets you see more recently in America and even more so in Switzerland and Japan are a reflection of these zero interest rates, leading to hoarding of money and central banks defensively reacting by buying lots of assets. But in the long run, we need to get on top of the problem, have a higher nominal GDP growth rate so that interest rates are above zero and people don't want to hoard a lot of zero interest currency or zero interest bank reserves. They have better uses for their money.
Right. And that active economy will let us unwind most of those trades.
Right.
And pull money out of the economy over time so that it's more or less.
It's our choice. I mean, we could have an inflation rate of as high as we want. Obviously, we don't want a high inflation rate, but it's also clearly true that countries that have high inflation, people don't hoard a lot of currency. There's much better options out there. So it's perfectly feasible to do things that reduce the size of our balance sheet in the long run. And we have to find that sweet spot where we have enough nominal GDP growth for interest rates to be above zero, but not so much that we get high inflation.
What could the Fed use right now practically as a leading indicator for targeting? Could they use tip spreads?
Some people think of tip spreads as measuring inflation expectations, but during this crisis, they're shrinking really for two reasons. Lower inflation expectations, but also the fact that there's a rush for liquidity, and conventional bonds being more liquid than tips, that's also shrinking the tip spread. But actually, both of those reasons call for more monetary stimulus. So we need to get those tip spreads back up to a more normal level, closer to 2%. And even though the tip spreads are not a perfect indicator, they're certainly telling us right now that money is too tight, as are many, many other indicators, none of which in isolation are perfect. But when you look at the mosaic, all of them together, the bond market, the stock market, the foreign exchange market, commodity prices, gold, oil, everything is signaling deflationary tendencies hitting the economy. I can't think of a single indicator that's otherwise.
In a practical sense, would you try to adjust, say, weekly, for example, with asset sales and purchases?
I would think they could even do daily adjustments, although weekly might be sufficient. I've argued the Fed should be always more nimble and market oriented. Like when they were targeting interest rates before it was zero, I favor daily adjustments in the target rate to the closest basis point, not monthly to the closest quarter point.
Right.
So that would have made policy much more nimble, and it would have taken a lot of the psychological element out of it. The reluctance to reverse course that the Fed has would not have existed if there were daily up and downs by just a few basis points. It's a more natural way to do an efficient policy than the current very inertial, slow-moving, in big steps adjustments.
So I'm an advocate of digital money and digital monetary policy, using an algorithm to replace the Fed. I guess that's something we'll talk about when we can get out of this coming recession. So tell people where to find you. You're at econlive.org. That's your sort of professional blog, right? That's the econ log. That's econlive.org. And your personal blog
is themoneyillusion.com.
And I'll put the links to those resources below. Thanks again to Scott Sumner, and I hope everybody stays safe.